Have you ever had a streak of winning trades only to lose it all in one choppy session? In this video, we'll break down why that happens, how to spot the behavioral and structural traps that lead to overtrading. You will also see a real trade breakdown on Mara, ES, and Q that show how structure help you stay out of trouble. Let's get into it. What we really see happening in the market is that we see the trader number one, right? Trader number one, and we can say this is trader number two. So this is trader one, this is trader two, and this is trader three. What happened is that one thing we are for sure that there is no trader in the market who doesn't make money at all. They all make money. So for instance, we can say that they were winning streak, they made the $500. Trader two maybe is more aggressive, is making 1,500, and the trader three is making more aggressive and it's making 2,000, right? In the first week. Second week continued, they made 750, they made 2,000, they made 3,000, right? And now these kind of traders are feeling over the high, they're feeling invincible, they're thinking that end of the week, end of the month, they'll likely be 10 grand up, right? Something like that. The other, again, they made the 750 and then made 3,000, they made the 4,000, and the last week come of the month. And right now we are on the last week of the month. And sometimes these things happen on the last week of the month. And what they do, this trader is smart, he understands the market, he understands the dynamics, he understands the trends, he understands the behavior risk reward. And what he does, he basically slow down, and then what do you think? He's reducing the risk. He took the first few trades, he lost 500, and what he did, he basically paused, not taking more trade. What they are doing, the moment they lost 1,500, they revenged it, they're retrading it, and just in the one day, not even the 1 week, they may be doing this. And then similarly, this trader is also like that. Ultimately, the winner of this is this trader. It doesn't need to be conservative, but what is that? You need to understand the market, how the market change. If you understand the market changes, market behaviors, market movements, you're going to protect yourself from those days which take all your capital and more. And why this happened, and this is just only one day, it's going to keep happening, and you might be doing this, you might be used to with this, and this is a cycle, right? This is called a bad habit cycle where traders start very good, win, and their equity curve are like that. And this just happened. If you look at it, either this is going to be happening in the 2 days, 1 day, or back to back 3 days, 4 days, and the weeks and months of progress is just gone. Why? Because what you're thinking that what you have achieved here, you can replicate here. The market doesn't function like that. Okay, market doesn't function like that. You need to have the understanding that the market give you the trades and then doesn't give you trade. You need to have this. When the heartbeat comes in, the heartbeat ECG. If you look at the ECG, if you do not have those movements, it means you're dead. But in equity curve, it doesn't mean dead. It just means more conservative, more preservance, right? So you go into that mode, hibernation, observation, less trading, more observation, and then you see when the structure is again aligning, then you go start trading it. You do not need to trade every day to be consistently profitable in any means. All right. So what I'm trying to say here is that if you wanted to be consistently profitable trader, well, you need to learn the habits to be every day when you come in, you need to identify what kind of a setups you're looking at it. Are you looking at a choppy days, inside days, right? You're looking at it big range days, or you're looking at the breakout days. When the real money comes in, the easy setup, what we call the easy setups, are the setups which you can easily identify the trends and you can identify the structure. You have some structure on the few days, and then you can just take the last leg. Don't preempt and anticipate the legs, but rather when you see the leg coming in, then you trade. So for instance, I think Harvey mentioned about Mara, right? And I said that, okay, this trade looks really good. Why? If you look at it, it was the third day of the cycle, right? Let me just show you here why I'm saying this is the third day of the cycle. So Mara is on the uptrend, right? And it made the new high. See how parabolic move it was, straight up, right? And then you see the topping tail. What happened? It made the swing high, then it came back down. This is the 200 SMA. It retested here, which has made the swing low. Then what happened? Again made the lower high, came back down, still holding the 200 SMA, didn't make the new low, so it's make the lower high, or you can say now it's become the higher low because it couldn't make the new low. And then what we saw, those who have shorted here, they get squeezed again, but didn't make the new high. Rather, it stopped exactly at the 21 level, which was the previous topping tail, and it's made the swing high, swing low, lower high. And what happened this time? Did it undercut or no? Let's just make that better line so we can see that does it really happen or no. Couldn't make the new low, came back here, undercut the new low, came back again. What happened? Previous high, you saw that it stopped on the January 2nd here. January 23rd started pre-market under the lows, and this is where I was telling you that this perfect breakdown, previous low undercut, and you see a big move coming in. And this one leg, if you have missed one leg, you wait for the bounce and you take the second leg. So ideally, the easy money trade comes in the second or the third cycle when you see a clear breakdown. And you saw that the clear breakdown happening here and here. You know, you have a structure, swing high, swing low, swing high, a lower high, lower low, lower high, and lower low, right? So if you can see those structures are breaking down, that's why you need to take the trade. And if you recall this morning, let's go back to the ES. Those who are on the stream, what I was telling you that ES is still holding 63.30. You can go back and check my stream. We have marked those levels, not now, it was marked earlier. And I was telling you that if it can hold 63.30, there is no way market is going to continue coming down. At that time, when we were looking at it, I was telling you that the NQ is pretty bearish, is losing all, but as far as, and I was telling you, you go back to look at the stream, and I was telling you that as far as it holds these levels, if you recall, do you recall that? I was telling you that, and that's exactly where we went long, remember? So I was saying that if it can defend this low, there is no way that it can go further down, and most of the time ES basically pull NQ with it, and that's exactly what happened. NQ failed to break down, right? ES was strong, holding the key level, and what happened next? It basically brought everything together over the highs. So what was the structure? The structure was swing high, there was a swing low here. Did we make any lower high? There was no lower high was made, right? This could be the lower high, and that's why you saw the immediate sell-off. But what happened? It unable to make the new low, right? And then move back up, consolidation again. Now what I was giving you reference that how you would identify the choppy days and stay away from them. Number one, identify whether you see any divergences between the two different stocks or two different things, right? So for instance, if you're looking at the futures of ES and Q, you look for both of them and see, do you see any divergence? If you see any divergence, it's better to avoid trading them. Look at them, that how fast it's moving from upside to downside, right? So January 22nd, it moved here, came back down on the second, on one day, almost how many points? 340 points. Is a really big week or day. You can say just one candle, right? And then when the reversal even happened, reversal didn't happen so fast. It was so slow. If you look at the price action, you can see it was really slow price action when it's trying to move back up. Again, we saw another sell-off, but sell-off happened, right? Immediate action. But if you look at it, it never breaks and make the new low. When, and I've explained to you many times, there's a part of our strategy sessions that if the structure creates, means a range created, when the range has failed to break down, the likely price action would be the reversal of it. Okay, sometime it take a couple of days to reverse everything, sometime it just take a 1 day to reverse, right? And you can compare from here. Look at this one. So this is the low, this is a high, this is the low, right? What happened? Do you see coming, that after this the price is moving back down? No, we saw clearly that price came here, made the new low, moved back up, holded all the moving averages, and then what happened? If it doesn't go down and make the new low, what usually happens is that market going to go back and retest the range. That's the way typical market function. You can take any stock, you can identify anything, and you can find that if the stock is not moving in a one direction, it's going to go back and retest those ranges. I'm not saying it's going to break out, okay? It's just mean that it's gonna touch this, maybe it come back down, maybe it start consolidating here, right? It can do anything, but most of the time stock doesn't like to stay within the range. Whether stock indexes, they don't like to stay in the range. If they're here, if it's not selling, the buyers comes in, short seller trying to cover them. When they come here, longs are trying to take the profit, shorts are trying to short, and then that's the way it's always function. Let's look at the one more idea, and then you can understand what I'm trying to explain to you. So just look at the Tesla. Okay, right now we just understanding the structure, and then I want to explain to you that how you can incorporate and identify the choppiness within that and avoid them to not lose money. So look at this, and let's try this. Okay, so we can say this is a structure, okay, and we can say this is a structure, right? And now let's see what happened. So what happened here, you can see 322 tested, made the swing high. What happened? Cannot claim the swing high. What happened? Came down here, made the new low. This maybe you can call the swing low here, right? What happened? Made the base, came back here. So now it came back here. What happened? Does it make the new low? No. So what I said, when the index come back, make the base, couldn't make the new low, what is the likely possible price action you would see in any stock or index? Is that it's going to go back and retest those ranges. So Tesla went back up and retest the range. You see that? Then it consolidated a few days, tried to came back down. Did it come down? No. It held those previous highs. You can see here, right? Let's remove this everything so you can see. So this is the previous high here, right? This base created, right? What happened? It came back down and then retested those. Now it's not going down, consolidating over the highs. What is likely going to do, right? If it's not coming back down, it's going to make the new structure. Now the new structure is created on top of this. So if you want to draw, you can draw on top of that, right? We don't know what's going to happen here, but I'm just drawing based on the previous structure. Let's redraw it so you can see, right? This is the previous structure, correct? Now you make the new structure on top. What happened now? Tesla broke out, move, consolidate, retested again the high, consolidated, gap up here. So up, made the new high. What happened? Came back down. So what happened? What is the likely action? If it's not going back up, what is going to do? It's going to likely, come on, speak up. What is going to do likely? Come on guys, I want to hear from you guys that you are following me. What is going to likely happen? Yeah, and go down and retest the previous high, right? Previous base. Now what happened here? It made the new low, but then didn't come back down, didn't break the structure. When it didn't break the structure, what's going to happen? It's going to go back again and retest the previous. And it's just happened day one and then day two. Pre-market retest, after market open retest, and then immediately pull back up. Then consolidated here, right? Day one, another July 23rd, consolidated, made some direction but couldn't break down. So far couldn't break down in the normal market hours. What happened then? Boom. Made the new high, came back down. I think this is a 4 o'clock candle. Retested it, couldn't break this high. Came back down, structure broke. Now where Tesla is right now? Tesla is in this structure right now again. It came back into this structure. So now tomorrow when we're gonna see, the Tesla would have two options, right? So right now Tesla is, sorry about that, let's just do it again. Now Tesla is within this structure, right? So maybe when right now it's here, right? If it make the base and fail to come back down, what's going to likely happen? it's going to protect this price and then move back up again. And if it couldn't break this, couldn't hold this level, then likely is that the market is going to push the Tesla to the 300 base. Okay, and then it's gonna hold there and couldn't break or couldn't go down further, and then start moving back up again. That's the way market will function. Market first, any structure comes in, market going to create the range, and when range comes in, either is going to break the range, make the new structure, or going to stay in the range. So now as a trader, which we do the intraday trading, what is the role is, right? That is more important for us to understand that how we can benefit from those understanding and knowledge from our structure. And you can see that you can backtest, right? So if this is the high of the structure, this is the low of the structure, where things get really choppy, the more closer anything, whether it's an index, stock, anything you're trading, any instrument, if it's come very close to that structure, it's better to avoid those trades into direction of going into the previous structure, because you don't know that how far, how quickly go, or it's going to hold there, what are you going to do. The best trade would it be either close to the structure on the reversal trade, right, or the breakout of forming a new structure, but taking before the structure and hoping it's going to break out, it is where that you're going to lose a lot of money. So for instance, just take an example, right? So Tesla is a good example because this was a nice range. So assume that this was the high, right? This was the range, correct? Yes or no, right? Assume you don't know anything here, or you don't know even what happened here. You just have this data. So you're gonna draw this one line here, and you're gonna draw this line here, right? So this is the range. So you just assume that you don't know what happened on July 16th. You only have a July 14th and July 15th data, right? So what I said. So when price starting coming in into the closer zone, what you need to do? What is the action what I'm recommending to you not to take? Tell me. What action we need to take? Exactly. So you don't take the trade, right? Because you don't know whether the index is going to break out, or stock is going to break out, or is going to fail, right? Like this, the way that fail here. You need to wait to see the price, how price is going to give it to you, and then you take the action. So first, when come closer to those levels, you don't take the action, right? So assuming that on the July 16th you are trading it, right? Now we have the data, right? Assume that you don't have the data, but you already in the pre-market planning, right? In the pre-market planning, right? In the pre-market planning on the July 15th, we say July 16th, right? So let's just zoom in, right? So you are July 16th, based on the July 15th, the base was created in the pre-market 9:30, the price is already here, right? So assume that you have missed this first trade, okay? So you were not watching it, and you have missed this trade, and market or Tesla immediately went back into the range of the previous highs. So if you have missed the first trade, what the likely action for you is to, number one, don't take it, because see how close you are, right? How close to this range is, right? So first thing is that you don't take it, okay? Don't take it, right? And if you just follow this advice, you can look at yourself that how choppy it is, 30 minutes. Look at this, up, down, up, down, up. Strong candle, no continuation, rejection, come down. You tell me that how would you handle 2 or 3 points pullback if you start trading the second trade hoping it's going to break out, and then in your mind is gonna be, hey, the trading is so difficult, right? This day you did not trade, or after every 30 minutes there's a new pullback, but today you want to try the same thing, that you're trying to take the breakout trades, but it's just failing, and you think, oh, trading is so hard, it's so random, why it's happening. It's happening because you do not understand the structure, right? So if you understand the structure, you will see that why you need to avoid that trade, because you're so close to the previous upside structure, right? So now what you need to do, so you don't take it. Number one, don't take it. What is the number two action? So for instance, this is the worst action can we expect, as that we see this structure, right? Maybe it went back up, try to consolidate it a bit, and then fail. And then when fail, For any trade you need to take it, you make sure that at least your 30 minute candle has to be below the 9 EMA. At least has to be the 9 EMA. And there should be a good distance between the 9 EMA and the 21 EMA for you to have a right risk to reward, right? If you would not have that, assume the 21 EMA is below, the price action is above and the EMA is below, you're likely not going to see any momentum, right? And you can compare here. So let's take an example of this, right? See how beautifully it's selling off. Why? Because it is all moving averages are above that candles, and that's why you see a nice momentum, right? But here, why this every move down is a pullback? Because that all the moving averages providing a very nice support to it, right? It's above the VWAP, even though it's dropping, but it's not dropping in a way that you're going to make money. Number one rule: don't trade when it's here, close to the level. Number two, wait for it, either breakout or breakdown, but that structure need to be at least be broken out into the 30 minutes. If the 30 minutes not break out, there's gonna be likelihood that you're gonna fail that. Number three, always trade in the direction of the 30 minutes moving averages. If the moving averages are not supporting you, there is a high likelihood that your setup is going to fail. Number four, never select your setup based on 1 and 5 minutes. 1 and 5 minutes are execution. If you're gonna start selecting your setups, right, based on 1 and 5 minutes, you're gonna see a lot of choppiness, a lot of failure, a lot of randomness, and that's why you're not consistently profitable, because the way you identifying the setup is 1 and 5 minutes, and when candle is, assume that this 30 minutes candle is for $3 to $4, and you're trying to set up and you're getting just failed. So look at this 30 minutes candle, how big it is. So this 30 minutes is from 312 to 318. This 30 minutes candle is from 319 to 314, right? So what does it really tell us? We tell us that market or the Tesla is in the volatility where the ranges of the 30 minutes are really high. Look at this 30 minutes on the July 11th. How does this look like? Came down, a very nice small 30 minutes, moving up, coming back down, nice structure. Those kind of a smaller candles, that's where you need to trade. You do not need to trade these big 30 minutes. These 30 minutes big candles are so risky, and you're going to lose a lot of money. So now, based on that, what we learned, let's go back to our slide so then you understand. Now you know the practical concept. We have understood some of the charts that what we need to look into. Where did my presentation go? Let me just find the presentation. Just give me 1 second. Alrighty, okay. Alright, so let's look at the learning objective, right? So you understand, so before we do more, do you guys understand what is choppy structure look like versus the trending structure? Do you have any question on that before we move further? Are you good? All of you guys? Good. Alright, okay. So right. So this is really important for you guys to understand. So what is the next, right? So if you understand what is choppy and the trending structure, you need to understand that the psychology behind overtrading are, how human functions, right? So what happening is, and I teach you in the past as well in the previous study session, every morning when you come in, the first question you need to ask that, what do you expect from the market? Do you expect market to give you a trend day, or you think that is a range day and we are on the bottom of the range, so you see the reversals or the breakdown, or that the market is, or the stock you've selected is, this is a range, this is a range, and market is opening close to those ranges, and you don't know whether it is going to come back down or come back or break out. Or 4, if this is the range, market is opening in the middle of it and you don't know. So personally, I don't like to trade those days when market is really open on the middle of the range, because the problem with the middle of the range is that it's really hard to understand that once market going to open, who's going to go and where market is going to go back up first, whether the market is going to go back up or you're going to get fake out and it's come back down. The most easiest trades are I think I can just do it again. Sorry, I removed it. Let me see if I can go to, okay, here, yeah. So I can see, okay. So the fourth one is really, for me, is really hard to trade. I like to trade the number 3 much more. Number 3, where I see that the structure is really breaking out in the one direction, or number 1. So my real setups, or maybe if you see that we do opening drive, the trend days, that's where we made a lot of money, when we have a clear trend days coming in, or we have a clear structure breakout trades coming in. And this 1 or 3 are where we make a lot of money. Last 2 days, we are trying the setup number 2, where market comes to the close to the range, right? And I was not expecting to break down, and we're expecting that, okay, market going to retest this range, and then likely action would be to go back up. And ultimately, both the days it happened exactly what we expect, but it was so slow and so choppy that's really hard to trade. So this setup, you need to be very cognizant when you're taking the reversal trades. It's hard to manage risk. Majority of the time, the new trader lost a lot of money into this setup. And I have personally, when I was learning, I have lost a lot of money on thinking that this is the bottom, and I add and go further. Either I stuck, then I averaged down, or whatever I wanted to do. I don't know what I was doing when I was learning, but this is the setup where your mindset really get off, and you can vouch for me what you do. So you tell me now that based on your own experience, what kind of setups you take, and what you think that you are best in managing the risk, and what are the things where you are not best in managing the risk. So this also, I want you to reflect while you're talking to me, so then you also understand that how you're managing your trades, right? So I want you to guys speak up. So tell me what kind of trades you take, and which one you are better in, and which one you are not better in, where you make more mistakes. Because everyone's has a different emotional structure and different triggers. So you would know where you get stuck. So tell me where you guys get stuck, one by one, if you can tell me. Okay, so you're saying that you're good in managing this, but what happens if you get fail here? What do you do? What is your second go to? Do you then start shorting it, thinking, okay, it's not trending, and you start shorting it, and then subsequently market trending up, and you get stuck into those? Yeah, no, I understand, but I'm saying, but if, for instance, what I'm asking you, maybe you can reflect back before I can move on and come back to you. But I'm saying that, okay, you wanted to take the open drive, either you miss open drive, or you unable to perform open drive. What you do next? That's my question is. So I will come back to you, think about it, and then I come back to you. Or make, yeah, go ahead. Yeah, exactly. So I think, in the next class, I'm going to talk about the concept of abundance in the market, and what is really, and I'm just going to give you a teaser, and then we're going to talk about next in the class. What happened is that what we really kill as human being to us is this, right? Or fallacy of missing dopamine cycles. What we really need to understand the market, that market has an abundance of opportunities, and if you miss one, you will get tomorrow next. You do not need to push everything today, and you're not going to get everything in the same day. It's okay to miss. You're not able to catch all the moves. Okay, if you understand just a little bit, you're going to see that your profitability, your consistency, your mindset will improve significantly. What does really mean? And we're going to deep dive into our next strategy class, but what I'm just trying to help you. So for instance, let's take an example. Okay, for instance, so you earn in your day job, assume that you earn 100,000, right? Let's just get an example. Okay, you're just earning 100,000 on your day job, right? Now what you're looking is that you wanted to be successful in day trading to replace this number. And what you're doing it is that, let me just open the calculator here. So what you're doing here is that you go here, you say 100,000 by maybe 250 trading days, and you say that if I make it 400 per day, you are set. Do you guys think like that? Yes or no? So, but the point is that you still think that way, right? And then the red day is also part of this thinking, I'm telling you. What about other guys? Come on, participate, right? So Megul, come on. So what, you guys still think that way? That, okay, you know what? I'm gonna get 400, 300, and that's why I'm gonna get the consistency, and that is called consistency in the market. But what is real? Yeah. So, all right, so it doesn't really matter whether, so see, that's what I'm trying to explain to you. It doesn't really matter, is a 400 or is a 1,000, is a 2,000, is 5,000, 10,000, 35,000, 50,000. Doesn't really matter. As far as you're thinking some number every day in your mind, that's basically, I'm telling you that this is the against the market spread of abundance. You will never be able to be consistent in the market, even though you spend 100 years in doing this. You're never going to be consistently profitable trader if you have this number in your mind. What in fact, and we're going to learn in the next session, I'm just going to teaser you that what really happens, what you need to do, okay? You say that this is I need to make in 12 months. That is your annual goal, right? And it's okay to have your annual goal. Now you're going to say that it's in order to achieve your annual goal, how much you're willing to risk. And you say, you know what? I am 1:2 guy, and I wanted to risk 50K to make 100K. If you accept this fact, when you accept this fact, that's where I'm telling you the consistency is going to come and follow you. You do not need to chase the consistency come and follow you. But if you're going to say that this is my goal and this is I need, even if you spend 100 years, you're not going to be consistently profitable. But if you're going to say that this is my goal, this is I'm willing to risk in the whole year, I'm telling you the consistency started. So assume that this is the way, and it's running and the consistency is following him. Just kidding. You know what I mean? Or Miguel, right? So anyone. The idea is that if you have this understanding, then only you're going to get it. And we're going to learn in the next class in the detail what I really mean to you. And you can reflect what I'm trying to explain to you here, and then I'm going to deep dive. And all this is connected. So this goal is connected with the risk, and the risk is connected with the setup. So if you have these three together as a triangle, then here is going to be the profit dollar sign. But anything is missing from here, you're not going to be consistently profitable. So what kind of setup do you like, and what would you think that which is your zone where you basically struggle and unable to stop loss or get revenge trading or miss the right? So what this really means that I'm trying to reflect it. So what this really means that you need to stop taking those range days, because if any kind of a setup triggers your emotions, the best thing you do is to just not to take those setups, because you still have other setups to take. Why you need to force yourself into the position where your brain and mind, emotion get out of control? And that's why I'm asking you a question to reflect. If you think that you take revenge in certain type of setups, my advice is you just stop taking those setups at all. Completely zero. Just ignore it. Completely remove those setups from your playbook. Don't trade those setups. What about you, Meg? Exactly. Perfect. Exactly. No, it's absolutely. See, it's a point what I'm trying to explain to you that that's why I've said everyone is different. Okay, I remember my early days. I also really pump up the trade. I open my computer. I find some trade. I use all my bullets in the pre-market, and then when market opens, I don't have too much to lose because I'm very close to losing everything what I made the day. So you are the better judge of your own emotions. Nobody can judge for you. So what I'm really preaching at this here is that you go and reflect that what is your emotional triggers. And best thing you can do, the Miguel did, that just remove all together. I know one of my the worst trades coming in on this kind of reversals. Okay. So I'm extremely cognizant when I take those trades. And you can see me when I take this trade, I usually put my hard stop losses because what I really hate about it that it's just dropped and you get stuck because these trades give you a very best risk reward. One of my best trades are also here when I take here. And if you remember a few past few months ago, some of my SPX option trades I made 8 grand, 10 grand, but just going long here and selling on the VWAP, right? But these are risky because if you remember, just today, not today, yesterday, the NQ leaked almost 200 points from the support area, right? You can't hold 200 points. Your account you're gonna blow your account. So the idea is that you enter, but you need to know the risk, and that's why I say, you know what? For instance, if it make the new low, right? I say I'm gonna go here and my risk will be this low, and I put the stop loss below that. If it's just touch it, I don't mind even stopping out immediately because I know even if I take 2 attempts, 10 points, next attempt is going to be my reward will be the 40 points. So I'm gonna cover this and an additional 20 points, right? I'll be the better judge where your emotion triggers, and best thing you can do is to protect yourself from those. You never need to expose yourself into those traps. So let me just remove it, and I think that it's likely we cover a lot of things, but I think we still need to do the next session on this before we jump to the abundance one. We discussed about it, the setup void, you really need to show. And on this topic, I already have a YouTube video created, and we do in the morning. If you come in the pre-market, I always ask you to map your day, identify it is the red day, yellow day, or green day. What does really mean is that based on that you will take the risk. For instance, go back to the theory I was saying, if you're 1:2 risk reward and you're saying that in the week, not the day, not the per trade, you say in the week you wanted to make 2 grand and you're willing to lose 1k. Okay, the smallest unit of your risk has to be the weekly risk unit, not the daily or the intraday. So for instance, you say 1k, so now 1k is your risk, so you're saying that I'm going to likely divide this 1k into the 4 trades. So I'm going to trade 250, 250, 250, 4 trades. So you need to identify, okay, how do you rate today? Is it green day, yellow day, or red zone? Red zone is mean that is a chop, small ranges, 5 points range, 10 points range. It's really, you need to make sure as a trader, you're not even trading those red zone. For you, no trade on the red zone. The yellow zone, you say, you know what, it's a mediocre day. Could be, so instead of 250, you say, you know what, I'm just going to go a base hits. I'm just going to go $100 risk, depending on your risk tolerance. You say, you know what, I'm just going to go 1:2, half of my risk unit, because I don't know, I'm going to be, it's a small range day. So you say, you know what, if I'm lucky, get the first range clear, I'm going to make 250, which is my 1 hour. I'm going to call it a day because I've already made the 1 hour. But based on your methodology, you say, you know what, this is a green day, market is breaking out, Tesla is breaking out, I'm trading the Tesla, it's above key level 300 level, there's a big chance to moving back up, moving to 310, 315. You say, what, you know what, I'm just going to risk 500 to deliver a trade, given the way the structure is, and you go more risk on the per trade, and then maybe in the one trade, maybe you make the 2k, which is your whole week return in just one trade. So if you are not managing your risk reward based on your day classification, there is a likelihood that if you're gonna equally divide, someday you're making money, other day you're trading and you come negative, and then you negative again, and the negative streak or red streak is going to be harder for you to manage because you're equal trader, right? So as session guardrails example is what Miguel said, you need to make sure that if you are vulnerable on certain stages, certain sections of the time, maybe pre-market, afternoon, you make sure that you don't trade on those. You have those guardrails to protect you. So if one of the thing is that you know that you can revenge trade in afternoon, so you put your stop loss on maybe 1 or 2 trades, the maximum 2 trades you can take it. Or before you even start trading it, put the system loss limits there in place, so then it protect you from yourself. Yeah, so as I explained to you that the checklist, you make the checklist every day, look at the structure, and on your post-it, identify, okay, today I feel like it's a red day, the chop day, I would not trade it. And at the end of the day, if you feel that the day is really turning great, then you go back and look at and analyze it, that why the day really went well and I was hoping otherwise into my pre-market analysis, and then identify those factors, improve your analysis, so next time you do better. Any question, guys? Sure. On the chart? Sure. So yes, yeah. So usually I don't go too far. I usually go one week, 2 week, because we're looking for the recent price action, but you can always gauge the importance of that level by going further down. Okay, so for instance, we only look the analysis up to July 14th because we are there, we already have high and lows, but you can see what is this level has any significance, right? This topping tail. Okay, let's go back and see, right? So you can go back and see they have the significance here, they have a significance here, they have a significance here, right? The bottom. So you can go and check the significance, but essentially market try to create the range within the weeks, 1 week, 2 week. That's why sometimes we can say that Monday is really hard to trade. Why we say Monday reversal comes in, because if Monday, assume that for instance this is a Monday here, right? This is a Monday, market opens in the bottom, right? And you're thinking it's going to continue, but what happened is that after morning it just has the reversal. Why? Because this is Monday, right? And this is the first day of the week. Market tried to create those structures from Monday to Friday, right? That's the way his market works. That's the way they order. So you can see here on the July 1st, this was the last week, right? What was the day on the July 1st? If we look at it here, what was the July 1st? July 1st was a Tuesday, right? So you can say, okay, what? This is a Tuesday. Tesla came in, retest to make the new low, the whole week gone. Now it's July 7th. July 7th is the next week, right? This is a Monday. Now what happened? Is this Monday, what Monday is going to do? Is it protecting this or no? So what happened here? Look at this. So Monday morning, market flushes. What happened? It couldn't go further down, right? Couldn't go further down. This is the bottom here, right? So immediately market has reclaimed. So one Tesla is reclaimed. What is the next best thing Tesla can do? You tell me. Based on the discussion, what we've learned, it's going to go up, right? As I said, but it's not going to happen in the same day, right? It's going to happen sometime same day, sometime multiple days. Given the distance, it started making the lower high, so it's making the swing low. You can say this become the new swing high, right? Or you say higher high, then higher low. Given it didn't make the new low, same double bottom, again new high, higher low, higher high, higher low, and higher high, and retested the structure. Now what happened in the structure? Could it further break out? No. Fail. Really fail? No. It just make and retest the moving average. It's still uptrend. Again go back and retest. Could make the breakout? No. Came back down. Right? So as I said, you need to be very cognizant when it come in the middle of the range. Now if you want to see here, this is here. This is a very big range, right? You can clearly see this. Normally this range never happened, but given the gap down, I think this is a day where news broke that something about Tesla and the President Trump, therefore is a big gap. It's really big gap. So what happened? Market came back down. Still look at this. It's still above the 200 SMA, making the U base, right? So no, don't want to go further down. What happened? It didn't go back down, move back up, and retested this base. what happened. So you always go with the structural base, and that's why I said that it's easier to trade here once it's break those levels, right, and under the moving averages. The moment it's claimed the moving averages, which is 21 EMA, now the trend is still on the upside range. So in this side, you cannot foresee that you're going to short. Yeah, sure. Yeah, I personally go to find the ranges within week and 2 weeks, but I always go back. Yeah, but I always go and look at on the daily chart to see that the significance of it. But given this is not a good example because Tesla is really in the big range for a while now, from months. So if you look at the monthly range, this is the mid is a 370, is 270. Then so this is not a good example. Let's look at any other stock. I think the Meta would be a good example because Meta has a good range just for understanding. So you can see here that how Meta creates the range. Because if the range are big, then of course the swings are also going to big, and you need to confirm the ranges. So if you look at it here, so this week you can clearly see the range, the structure. It's very easy to see the structure here. You see that? So it's really easy to see the structure. Now you can clearly see it make the new high, swing high, and then it's making lower highs, right? So right now we are on the triangle, on the ascending triangle, descending triangle. We don't know whether Meta is, after this touching air, is going to move back up or is going to come back down, right? Trend wise, you can clearly see it's holding moving averages, but it's making lower high. So if it's a lower highs, because this is not a straight line structure, right? Now what we learn is that in the other examples, we are talking about the straight line structure. This is not the straight line structure. This is the descending trend line structure. So it's bad so you just need to be cognizant of that. Just like this structure is a straight line structure. It's basically horizontal range, but this one is not a horizontal range. It's basically either, if you want to say, some people can even say the flag, right? Yeah, this is the big flag, and after this breakout, if this flag break out, it can make the new high. Or if it fails, it just go back and retest this flag. But just be cognizant about that. What kind of structure is created? It is a downside, is a horizontal, just like here on this side if you look at it. So this is not purely in the horizontal structure. It's just that you can clearly see that it's making the structure like this, right? So just be cognizant on that. But otherwise, everything is fine. From the range theory is same, whether breaking out or breaking down. So if you look at it here, as we're saying, let me just draw a little bit lower so you can see. And so look at this. So I was saying this, right? So you look at it here, it's a couple of times broke out and failed, and when it's really break out, it's retested this line. You see that crossing over moving averages. Just be cognizant about what kind of a range is created. That's it. And if we just purely talk about our ES, so you can clearly see that during the last month we are in a lot of range breakout days, and we had made a significant good trading across all this period. Everyone was saying, oh, we're gonna short, and we're saying no, it's really range, right? Remember, if you guys remember, again it's consolidated. Again we are saying that it's consolidating, and then breakout happened, right? So this is a pure example of the horizontal range days, and you can see that all these ranges are the weekly ranges, right? Or 2 week range. So if you go here, this is 2 weeks range, this is a week range, 10 days range. Again here, starting from July 1st to all the way July 15th, so 2 week range created and then broke. And you can always reconfirm those ranges through the weekly chart. If you recall and go back, I think last class when we explained to you, and I was telling you that this is, see, in the weekly chart is just consolidating and seems like we're gonna break out here. Do you remember? Do you guys recall? So look at this, exactly on the weekly consolidation and then breakout. So this weekly range usually get really confirmed through the weekly chart. Any other question, guys? We're running over, but yeah, if any question I can take it. If not, then we can cover into our next class. The next class topic is really important to deal with how we can have the right mindset to pull the money. Just if we are struggling to make 100,000, right, in the whole year, well, market moves $1 trillion in the one day. Why? Because our focus is different. The way market functions, this is not what we are thinking. If we are thinking very narrowly from our own perspective, and think, since we are thinking from our own perspective or mind, that's why we're making wrong decisions. Once we start thinking like this, that there's abundance of opportunities in the market, one failed trade means nothing, one good trade means nothing, right? One missed trade is nothing. Once we have that kind of a mindset understanding, that's where you're never going to know that this 100,000 may turn into $10 million. So see, everything depends on your style, right? Everything is dependent on style. So for instance, so if you go back, for me, especially for me, these days are difficult, right? Because it just market was just dropping, and I don't know, these kind of volatility is really hard to gauge. That how it's so extended, so it's really hard to really think through those things from mindset perspective. But for instance, if you go to 2018, 2022 was the bearish year, right? What bearish years means that the market was just making lower highs, extended moves into 1 month and then fail, right? You can see clearly here, 2022 here, market is just making the lower highs. For who this will be difficult here? Those who are swing traders, right? Those who are the swing traders, they have a lot of difficulties, right? Because there is no trend. They really need to make the position. So I know so many who made a lot of money in 2021 in the COVID-19, and they have lost everything. Why? Because they cannot comprehend, they cannot adjust it to the fact that the market has changed, right? Similarly, I know many people who just went long on this fall. And you can, if you start looking at it, go back to the Twitter feed, and you're gonna find a lot of traders who were just buying the dip here, and ultimately they have lost a lot into these 3-day pullback, and they blow their accounts, they stop out, they lost their positions, they lost all the gains what they have made in the last 2 years, just because they are reckless, and they were not able to understand that market has lost their support here. And no, always, see, it's always going to happen, but you need to understand that market goes in the cycle. Even in the bear market, there is some sector has a bull market, okay? Even in the bear market, it's not going to be like the straight line coming down. No, there will be days where move back, and the best way is not to listen to any opinions, okay? Opinions has no value. You go back and look at the retest of this area of the opening ranges, and I can bet you can look at from the candle opening, came in and then failed. There's a little bit top and then failed, little bit top and failed. What does it really mean? It really mean that you need to understand, when you know market is below the 21 EMA, right? You have two options, right? Either you trade the way market is asking you to trade, which is basically take the opening drive but downside, not on the upside, or you just don't trade it. Nobody's forcing you to trade. You only trade on the day when you clearly see the structure is breaking out. For instance, if you see that this structure is created and breaking out, you go long only on this day. So you need to be very selective. If you're just a long side trader, you need to be selective, but there will be opportunities, but it's just selective. Just like here in this market, if you're trying to short, you're gonna murder yourself. There's no opening drive downside, but there are some days where only opening drive downside is going to work, just like last 2 days, right? You need to be selective, right? If I'm short bias trader and I'm shorting every day last 2 months, I'm going to be bankrupt. If I'm a short biased, my line of action is that I understand the market. I need to accept that market is bullish, it's upside, trending up. If I want it to be a downside move, I need to be selective. And every day when we start a session, I keep remind to all of the traders that you need to be very strong in selecting the short trades, because this market is unforgiving for the short traders. Okay, if you're gonna short on the wrong side, you're just gonna kill your account. Similarly, if from the February to the April, if you are long side traders and you're going long, I don't think so you could have survived. You would not be even trading today. Yeah, see, it's all depend on. So it's always be there, but you need to think from the structural perspective. For instance, I will show you the chart. Okay, I will show you the chart, and you're gonna see what I'm saying. And this will be the last question we take because it's already 9:30. But I will just explain to you. So look, go back to the NVIDIA chart. Okay. So NVIDIA is really weak after it made the new high here, right? In December, January, it made the 151 as a new low. So even though this clearly a downside move coming in, okay, I think here, this one, so this area, clearly market is gapping down, NVIDIA losing everything, but NVIDIA is this range, right? You can go back and replay. I will tell you that in this area, even though you see the red candles bottoming tail, but I have traded this area. This is the worst area to short. Worst area to short. You will not be able to survive the shorts, even though you can see the bottoming tails, red days. But these shorts are very complicated shorts. There's no new short. So you also need to understand, are you in the range, and then what range look like? These are all inside days. That's why it's really hard. So I don't even trying to short it, right? What you need to see is that, okay, once the range broke, make the lower highs, right? Okay, now you need to see, okay, look at these shorts. Look at these shorts. These are the much cleaner shorts. Look at this, beautifully 1, 2, 3, 4. Look at this, how beautifully falling down straight downside. But this, even though the price is in the same range, so you need to see the structure. That's why when somebody tell me that he's an opening drive, blah blah blah, I know from the fact that they cannot be consistently profitable trader if they just think that they only take over. Unless you understand the structure, the context of the market, the way market is moving, why it's moving, what sentiments are in, what news, what macros. If you do not have that understanding, by just looking at the setup, you're gonna fail. And those questions you're asking because you do not understand the overall market structure. Once you understand the market structure, then you know, okay, what, this structure, this context doesn't even require me to take open trade. Why would I trade? I don't have any edge on that trade. So there's always going to be bullish days, is always going to be red days, red green days in any market. But do you want to trade those trades? That's the question, right? That's the question. Yeah. All right. When you stop chasing every candle and start recognizing structure, your equity curve changes. In the next part, we will dive into the setups to avoid inside ranges, how to use EMAs for confirmation, and what to do when there is no setup at all. Register for the next weekly strategy class at Smart Traders. And don't forget to subscribe the channel so you never miss a live breakdown.